Welcome to Breaking News to Trading Moves. $80 billion. To put that into perspective for you, Alphabet is planning to spend, well, more capital on artificial intelligence infrastructure than the entire gross domestic product of many small nations.
Yeah, it's a staggering amount of cash.
Right. And they are not acting alone here.
Mm.
Berkshire Hathaway plans a $10 billion investment in the deal. So our goal today is to discuss the headline and then break down the winners and the losers.
The stakes here are, they are absolute. The artificial intelligence race has entirely moved past chatbots or, adding a generative text feature to a word processor.
We're talking about hardware now.
Strictly hardware. It is about who can fund the physical compute build-out, who can secure the actual silicon, and crucially, who can turn that massive amount of spending into real, tangible profit.
So before we start naming specific companies, we really need to pause and evaluate what a number like $80 billion actually indicates for the broader market.
Right, because it changes the math for everyone.
Exactly. Does an $80 billion raise mean the market is just starving for compute power and demand is insatiable? Or is this, a blaring warning light about the soaring, prohibitive cost of competing in this space?
Traders are splitting into two distinct camps on that exact issue. The bullish read is entirely focused on a supply deficit. Right now, demand is just running far ahead of available supply.
So everyone is just scrambling for the same resources.
Yeah. Every major enterprise, government, and research institution wants to train complex models, and they physically cannot get enough compute power to do it.
Wow.
So from that perspective, raising this capital is simply required to build capacity and capture the revenue that's just sitting on the table.
Okay, so the optimistic view is that Alphabet is just building the necessary farms to harvest an overabundant crop. But the bearish view must focus on the toll it takes to build those farms, right?
Exactly. The bearish read focuses squarely on the barrier to entry. The cost of competing is much higher than investors expected, well, even 6 months ago.
Because $80 billion is a lot, even for them.
Think about the gravity of it. Alphabet generates tens of billions in free cash flow internally. If a company with that much inherent wealth needs to go to the outside market to raise $80 billion just to keep pace, the financial barriers to entry are astonishingly steep.
That makes total sense.
Yeah, it suggests a capital expenditure environment that could severely punish balance sheets across the entire technology sector.
And we have to factor in Warren Buffett's company here. Berkshire Hathaway planning a $10 billion investment in this exact deal adds a completely different layer to it.
Oh, absolutely.
Because Berkshire is notoriously strict about value investing. They buy railroads and insurance companies. They don't usually throw cash at speculative tech.
No, they don't. Their involvement gives the deal serious credibility. It tells the market that this is a viable physical infrastructure play, not just software hype.
They want hard assets.
Right. Berkshire Hathaway looks for predictable cash flows and hard assets. However, even with that stamp of approval, you can bet traders will scrutinize the rising capital expenditure required to stay in the game.
So it's a blessing and a curse.
Exactly. Berkshire's presence validates the reality of the infrastructure, but it doesn't erase the margin pressure on the tech companies actually building it.
Okay, let's follow the money then. If you are Alphabet writing an $80 billion check, someone has to be on the receiving end of those purchase orders.
Oh, definitely.
I want to look at this like building a high-speed rail network. You have the companies building the engines, the train cars, the tracks, and the switching stations. So who is providing the physical engines for this AI build-out?
The clearest winners right now are the AI chip and custom silicon suppliers. First, you have Nvidia, ticker NVDA.
The heavyweight.
Yeah, they remain the undisputed leader in graphics processing units. When Alphabet builds a new data center, Nvidia's accelerators are the primary engines doing the complex mathematical heavy lifting required to train these massive language models.
But if you are Alphabet, you definitely don't want to hand all $80 billion to one vendor, right? You don't want to create a monopoly that can dictate prices to you forever.
No, that would be terrible business.
So how do they spread that money around to protect themselves?
That brings us directly to advanced micro devices, ticker AMD. They benefit specifically because hyperscalers, the massive cloud providers, are actively searching for supplier diversity.
They need a backup plan.
Exactly. No buyer wants to be completely captive to a single vendor for their most critical components. AMD provides a highly competitive alternative, allowing Alphabet to negotiate better pricing and secure a secondary supply chain.
Okay, so that covers the core processors. But when you string together, what, 100,000 of these graphics processing units in a single building, the bottleneck isn't the individual chip, is it? It's how fast they can talk to each other.
That is the crucial mechanical bottleneck, yes. And it's where Broadcom, ticker AVGO, enters the picture. Getting thousands of processors to share data without latency requires specialized networking silicon.
Otherwise, you just get massive traffic jams.
Right. Broadcom provides the nervous system that prevents those traffic jams. Furthermore, these data centers use custom AI silicon designed specifically by Alphabet for their unique workloads.
Oh, I see.
And Broadcom provides the engineering foundation and the networking infrastructure to make those custom chips a reality.
Well, I want to talk about the physical servers themselves, too.
Yeah.
Because you can't just take a $30,000 chip and plug it into a standard motherboard.
No, absolutely not. It requires highly specialized housing. We are talking about custom racks, massive arrays of memory, specialized storage, and complex server integration.
So who builds those?
This brings us to companies like Dell Technologies, ticker DELL, and Supermicrocomputer, ticker SMCI. Both are directly tied to AI server demand because they actually assemble the physical architecture that houses the silicon.
Wait, hold on. If Nvidia commands such massive margins on the chips themselves, what is the reality for the companies building the boxes those chips go into?
That's a great question.
Are Dell and Supermicrocomputer making the same kind of profit?
No, and that is a critical distinction for traders to understand. The server assemblers face severe margin compression.
Because the chips are so expensive.
Exactly. Because the core silicon from Nvidia is so expensive, the companies wrapping sheet metal and power supplies around those chips are forced to operate on much thinner profit margins.
So the revenue looks great, but the profit isn't.
Yeah, their revenue numbers look spectacular because the end product is so expensive, but their actual percentage of profit is much smaller.
What about Hewlett-Packard Enterprise, ticker HPE? Where do they fit into the server hierarchy?
They are positioned to benefit as enterprise AI infrastructure accelerates.
So not the massive hyperscalers.
Right. While Alphabet is a hyperscaler building mega facilities, regular Fortune 500 enterprises are starting to build out their own smaller-scale on-premise AI servers to protect their proprietary data. HPE is a prime vendor for that specific corporate tier of the market.
Makes sense. Let's move beyond the servers to the physical environment. You cannot just plug these massive racks into a standard wall outlet.
Definitely not.
You can buy the fastest engine in the world, but you still need a highly specialized garage, premium fuel, and a way to keep the engine from overheating when you push it to the limit.
The physical infrastructure demands are staggering. Let's start with thermal management. Vertiv, ticker VRT, is tied directly to cooling and critical digital infrastructure.
I need to stop you there. Are they literally running water over these electronics? Explain why traditional air conditioning isn't enough anymore.
They essentially are. Standard air cooling physically cannot handle the thermal density of these new processors.
Oh, wow.
Yeah, if you try to push chilled air over a concentrated rack of AI chips running at full capacity, the silicon will literally melt.
Melt, really?
Yes, the heat output is too extreme. You need advanced liquid cooling solutions, piping coolant directly to the plate sitting on top of the processors to extract that heat efficiently.
That's wild.
And Vertiv designs and implements those exact liquid cooling systems.
And what about the electrical side? A facility like this must draw the power of a small city.
Easily. For electrical systems and power management, Eaton, ticker ETN, is intimately linked to the build-out. You are routing hundreds of megawatts of continuous power into a highly concentrated space.
So they manage the grid connection.
They provide the mega-scale transformers, the switchgear, and the grid management tools. Crucially, they provide the uninterruptible power supplies.
Because if the power drops...
Right. If the local grid blinks for even half a second, a billion-dollar training run could crash and corrupt months of data. Eaton provides the massive battery backups that bridge the gap between a grid failure and the backup diesel generators spinning up.
You also need a place to put all of this. You can't just zone a lot in a suburb and drop an $80 billion data center there.
No, zoning is incredibly complex. For physical real estate, the market looks at Equinix, ticker EQIX, and Digital Realty Trust, ticker DLR.
These are the data center trusts, right?
Yes, the major data center real estate investment trusts. You need proximity to massive subterranean internet fiber backbones and direct access to a robust, high-capacity power grid.
So they own the land of the buildings.
Exactly. These real estate trusts own, secure, and manage the specialized facilities that hyperscalers lease out.
Okay, let's pivot from the companies receiving the purchase orders to the companies footing the bill and feeling the financial pressure.
The ones writing the checks.
Right. And this leads to a counterintuitive reality. Alphabet is raising the money to dominate this new technology, but traders are listing them as a potential loser in the short term.
It sounds backwards, but it's true.
Are they building a new profit engine, or are they just aggressively defending their current search and cloud positions?
That tension dictates how the stock will trade. Let's look at Alphabet, ticker GOGAL, and Oracle, ticker ORCO. The immediate worries for the companies spending the money are equity dilution and drastically reduced free cash flow.
Let's walk through the exact mechanics of dilution for the listener who holds Alphabet stock in their portfolio right now. How does this $80 billion raise actively hurt them?
Think of the company's total value as a pizza. If you own a slice and Alphabet issues new shares to raise $80 billion in equity, they are essentially cutting the pizza into more slices.
So your slice just got smaller.
Yes. Your specific slice just got smaller. You own a smaller percentage of the company's future earnings.
And what about the cash flow?
Furthermore, dumping $80 billion into concrete, copper, and servers directly reduces the cash the company has on hand to buy back stock or pay dividends.
Which brings us back to the motivation. Are they spending this to grow or spending this to survive?
We often refer to this as the Red Queen effect, running as fast as you can just to stay in the same place.
Right, from Alice in Wonderland.
Exactly. Traders are asking, will this massive investment generate entirely new high-margin revenue streams? Or is this merely the new cost of survival to prevent rivals from stealing their existing search and cloud market share?
If it's just defense.
If it is just defense, that capital expenditure eats directly into profitability without actually growing the bottom line.
That makes the stakes incredibly high for Alphabet. But this doesn't happen in a vacuum. How does an $80 billion benchmark impact their big tech rivals?
It forces their hand. We are talking about Microsoft, ticker MSFT, Amazon, ticker AMZN, and Meta Platforms, ticker META. All of these companies are locked in a vicious arms race for artificial intelligence dominance.
Because Alphabet is pushing the ceiling higher, these rivals have no choice but to match that spending to avoid falling behind.
Exactly. Alphabet just made the game substantially more expensive to play. These rivals must now increase their own capital expenditures.
Which hurts their margins too.
Yes. This makes investors highly sensitive to their profit margins. It is very easy for Wall Street to forgive heavy spending when interest rates are zero and money is cheap.
But not at $80 billion.
No, when the numbers reach $80 billion, patience runs out rapidly. The market is going to demand a precise timeline for when this AI infrastructure will actually start returning a profit.
You might be thinking, why can't older, established technology companies just swoop in and take a piece of this pie? There are massive legacy players that have been around for decades, but they don't seem to be catching the tailwind of this specific infrastructure build-out.
The current market structure violently rewards clear infrastructure winners while actively punishing slower-positioned legacy companies.
So if you miss the boat, you're stranded.
Pretty much. When capital allocation is this concentrated, the companies that miss the initial wave of purchase orders are left stranded. Look at Intel, ticker INTC.
They've been struggling lately.
They are still engaged in a multi-year turnaround to rebuild their data center and foundry manufacturing business.
So they aren't ready for this wave.
Right. While they have long-term plans to manufacture chips for other designers, they are entirely missing out on the immediate astronomical profit margins that Nvidia is capturing today.
What about IBM? They have been talking about artificial intelligence capabilities for years, long before this current frenzy.
IBM, ticker IBM, certainly has exposure to artificial intelligence, primarily in enterprise consulting and software integration.
But not the hardware.
Exactly. They lack direct leverage to the physical hard asset infrastructure build-out we are analyzing today. When $80 billion is explicitly earmarked for raw concrete, liquid cooling arrays, and custom silicon processors, IBM simply isn't the primary recipient of those massive purchase orders.
And Cisco. They dominated networking for years. We just discussed how crucial networking is for preventing data bottlenecks.
Cisco, ticker CSCO, does have massive networking exposure across the corporate world, but traders are favoring faster-growing, specialized AI data center components.
So they prefer Broadcom.
Yes, Broadcom has completely captured the narrative for the specific high-speed optical interconnects required for AI clusters. Cisco is currently viewed by the market as a slower-moving, traditional enterprise networking play rather than a direct hypergrowth beneficiary of this specific hyperscaler buildout.
So we have the companies building the physical environment, the companies providing the silicon brains, and the massive tech giants footing the bill. If we synthesize all these mechanics, what is the ultimate takeaway for the listener managing their own portfolio?
The primary lesson is that this event creates a very defined structural long and short setup.
Okay, let's start with the long side.
The long side of the trade favors the suppliers who possess pricing power and highly visible demand. These are the vendors selling the physical picks and shovels, the custom silicon, the advanced liquid cooling systems, and the specialized power management grids.
Because everyone needs them right now.
Yes, because the demand for these tools vastly exceeds the available supply, these companies can maintain high profit margins and predictable revenue streams. They hold all the leverage in the negotiations.
And the cautious side of that setup.
The cautious or short side involves the hyperscalers themselves, the companies that are forced to spend this capital.
The Alphabets and Microsofts.
Right. They are staring down potential equity dilution, severely reduced free cash flow, and intense Wall Street scrutiny before their new AI products are fully proven to generate profit.
It's huge risk for them.
The fundamental dynamic is this. The hardware vendors get paid today in cold, hard cash, while the software companies are spending billions hoping to get paid tomorrow.
The hardware vendors are securing their revenue right now, while the tech giants are absorbing all the financial risk and burden. As billions of dollars are poured into concrete, copper, and silicon today, it leaves you with a crucial question to ponder on your own.
Exactly.
Given the sheer scale of this capital expenditure, how many years will investors patiently wait before demanding these massive, power-hungry AI data centers generate matching software profits? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.